Hello and welcome. Think of what we're doing today as a kind of a morning health checkup for the U.S. economy. We're going to take its temperature, check the vitals, and see what today's test might tell us. Okay, let's dive right in.
Okay, right off the bat, wow. The year has just been incredibly strong for the S&P 500, up nearly 15%. I mean, that's a picture of really robust health. But, that's the story of the year so far. The real question is, what's happening today? What are the symptoms telling us right at this moment?
So, to get a clearer diagnosis, here's our plan. First, we'll check the market's morning vitals. Then we'll dig a little deeper into the forces of push and pull that are creating some tension. After that, we'll zoom out for the bigger economic picture, and finally, we'll look at the key results that pretty much everyone is waiting for today.
Okay, so let's get started with part one, the morning vitals. Just like any good checkup, you gotta start with the most important high-level numbers to get a baseline reading of what's going on. And look, that impressive yearly growth, it's not just coming from one place. I mean, sure, tech is still on a strong run, but you can see here that energy and financials are also posting some serious double-digit gains. This is a really key sign, right? It tells us the market's strength is broadening out. It's definitely not just a one-trick pony anymore.
But here's where it gets interesting. This is our first kind of contradictory symptom. Even with stocks doing this well, the price of gold is hovering near its recent highs. We're talking around $3,300 an ounce. So what does that mean? Well, it signals that while a lot of people are optimistic, a pretty significant number of investors are also hedging their bets, racing for a little uncertainty.
And if we take a look at some other vitals, you can see that energy prices are definitely feeling some upward pressure. Crude oil is sitting in the mid to high 60s per barrel. Now, this is a number you really want to watch closely because these prices can have huge ripple effects across the whole economy. I'm talking about everything from shipping costs for businesses to, what you and I pay at the pump.
Okay, so we've got the vitals, but what's actually causing those contradictory signals we just saw? To figure that out, let's move on and try to diagnose the underlying symptoms. Let's look at the competing forces that are at play in the market right now. And to do that, we need to get a handle on a really key concept, the ratio of stocks hitting their 52-week highs versus the ones hitting their 52-week lows. It's actually pretty simple. Just think of it as a measure of the market's internal health. It answers the question, is the strength we're seeing widespread, or is it all just concentrated in a few hotspots? And wow, right here is where you can really see the market's internal conflict. It's a tale of two tapes. On one side, you've got roughly 250 stocks hitting their yearly peak. We're talking quality, established names like MasterCard and Johnson & Johnson, driven by really strong earnings. But then on the other side, you have about 100 stocks hitting their yearly lows. And these are mostly in those more speculative, tech, and cyclical areas where investors are getting a bit nervous.
This really captures the essence of what's going on, doesn't it? It is not one single market moving in lockstep. Nope. What we're seeing is a story of two different markets. It's like a tug-of-war between the reliable, established players and those more growth-orientated, speculative ones.
All right, so that brings us to our third section. It's time to zoom out a bit from the market tickers and take a look at the health of the broader economy that this all operates in.
So the overall economic report card, it looks pretty solid. You've got GDP growth holding steady at 3%, unemployment is at 4.2%, which, it signals a little bit of cooling in the job market, but that's still historically very strong. And the 10-year Treasury yield, which is a big benchmark for borrowing costs, is sitting at 4.3%. All in all, a stable, if not totally perfect picture.
But if we dig into that yield number just a little bit, we find a subtle clue. See, it dipped just slightly today. So why does a tiny dip like that even matter? Well, it's because it tells us that bond investors, who a lot of people call the smart money, are basically in a wait-and-see mode. They're kind of holding their breath, waiting for the next big piece of economic data before they make their next move. And that leads us perfectly into our final section, which is all about those upcoming tests and results. What is the exact data that everyone, from Wall Street all the way to Washington, is waiting on today? So, the big question is, what could actually change this picture today? We've got this delicate balance, right? Strong growth on one hand, but this underlying caution on the other. So what events happening today could tip the scales one way or the other?
Okay, here's the schedule for today. The day kicked off with a speech from Atlanta Fed President Raphael Bostic. But the real main events are at 8:30 a.m. when we get the latest data on jobless claims. And then at 10 a.m., buckle up because we get a doubleheader, existing home sales and the services report. So it's going to be a busy morning for economic news.
So here's what you want to be looking for in all that data. First, that jobless claims number. It gives us a real-time pulse on the health of the labor market. The forecast is for around 224,000. If the actual number is way off from that, you can bet it's going to move the markets. And then the home sales data. That's going to tell us a ton about consumer confidence and the state of the super important housing sector.
And hey, it's not just about government data today. We also have some major corporate earnings coming out. The big one, the one everyone is watching, is Walmart. They're reporting before the market even opens. And because of its massive size, Walmart's results are basically seen as a direct signal of the American consumer's financial health. Seriously, what they say about spending habits, it matters to pretty much everyone.
So there you have it. That's our economic health checkup for today. The patient, well, the patient is showing some really strong vital signs, right? Solid growth, healthy yearly returns, but there are also these clear signs of caution. You've got investor hedging, a divided market internally, and this general wait-and-see attitude ahead of all this data. It really is a balancing act, and the big question that today's data is going to help us answer is, which way is it all going to tip?